Welcome to Talk Tickers. Today, we're diving into Delcath Systems' big second quarter earnings call. And this is a really fascinating one, folks. You've got a company hitting this incredible inflection point, putting up just explosive growth, only to see the market's excitement kind of fizzle out during the day. So what is really going on with DCTH? Let's get into it.
So let's just start with the number that made everybody sit up and pay attention, a whopping 210% jump in revenue year over year. I mean, wow. This wasn't just a good quarter. For Delcath, this was a statement. It was a crystal clear signal that their whole commercial strategy for the HEPZATO kit isn't just working, it is taking off like a rocket.
But here's where the story gets a little weird. The initial reaction from the market was just pure excitement. The stock shot up almost 18% in the pre-market as soon as the numbers hit. But then, look what happened. By the end of the day, that huge rally had just evaporated, closing up a much quieter 5.5%. That is a massive disconnect between the open and the close.
And that right there is the big question we're tackling today. You've got this huge beat on every metric that matters, but a rally that just ran out of steam. So what did the market hear on that earnings call that made them tap the brakes? Well, that's exactly what we're going to unpack right now. Okay, first up, the headline beat. And really, you can't overstate this. This was a profitability inflection quarter. Let's look at what got everyone so fired up in the first place, because the results themselves were frankly stellar. This was the quarter where Delcath officially flipped the switch from burning cash to making it. So on the top line, they pulled in $24.2 million, which just sailed past what analysts were expecting. But the real jaw-dropper was on the bottom line. Wall Street was looking for maybe a couple of pennies in profit, but Delcath came in with 7 cents per share. That is a clean, solid beat across the board, no two ways about it. And when you look under the hood, the business just looks incredibly strong. Gross margins came in at a spectacular 86%. The company swung from losing almost $14 million last year to a $2.7 million profit this year. And get this, the balance sheet is basically a fortress. We're talking $81 million in cash and zero debt. All of this is being driven by the fantastic adoption of HEPZATO in the US, which accounted for $22.5 million of that revenue. All right, Section 2, Management's Playbook. This is all about their strategy for scaling a novel therapy. Because with numbers this good, the question immediately shifts from what just happened to, okay, how do you keep this going? Management laid out a really clear game plan, so let's walk through it.
Their whole strategy really boils down to three main things. First, they're going to keep expanding their network of cancer centers that can actually do the procedure. Second, they need to make it super easy for hospitals to get paid, which means driving payer access. And third, they're looking to the future, advancing their R&D pipeline into other types of cancer.
Now, that second point about driving payer access brought up a really important topic on the call, something called the 340B program. Now, if you're not in the weeds on this stuff, it's basically a deal. It's a federal program where drug companies agree to give pretty big discounts to certain hospitals. So why would they do that? Well, in return, it unlocks crucial Medicaid and Medicare coverage. It's all about market access.
And this is a really key point because it's a strategic trade-off. So here's the deal. By joining this program, Delcath makes it way easier for hospitals to get reimbursed, which long-term should mean more patients get the treatment. But there's a cost. And it's an immediate 23.1% discount on about half of their sales. Management said this is going to lead to about a 10 to 15% dip in the average price they get per kit starting next quarter. And that's a detail the market really had to chew on.
And that brings us right to the heart of the matter, the execution story. This is where we figure out how to reconcile the promise with the pace. Because this, right here, is the answer to our big question about why that morning rally just fizzled out. It's that classic battle between an amazing story and the messy, real-world details of making it happen.
And look, you don't even have to take my word for it. The CEO, Gerard Michel, said it himself on the call. He said that while they're making good progress, the pace of getting new treatment centers up and running is just a little bit slower than they originally hoped. So now they're guiding for 25 to 28 centers by the end of the year, which is just a slight trim from their old target of 30. And that little change, however small it seems, was enough to make investors nervous.
So this really sets up the two competing stories for the stock right now. I mean, the bull case is just so powerful, right? You've got explosive growth, consistent treatment rates at existing centers, and that beautiful debt-free balance sheet. The bear argument, though, is all about the pace. Slower site rollouts forced them to trim their full-year revenue guide just a hair, and the call really highlighted how complicated it is to get these new sites onboarded. And just like that, the whole conversation shifted from the amazing growth to the risk of execution.
So, let's put it all together. Time for the next call, our prediction and our rating. Where does Delcath go from here? And, maybe more importantly, what should you be watching for when they report again next quarter?
All right, our official rating here at Talk Tickers is outperform. We think the market has seriously overreacted to the slowdown in the rollout. It's punishing the stock for what are likely near-term logistical headaches, while totally underweighting the huge deal that this shift to profitability is. In our view, the core growth story is 100% intact.
So, for that Q3 report, here is your watch list. First, revenue. We're looking for something between 24.5 and 25.5 million. That'll prove demand is still strong even with that new pricing. But the number everyone's going to be watching is new centers activated. We need to see them add 3 or 4 to get back on track. And finally, keep an eye on that gross margin. As long as it stays in the low to mid-80s, it proves this new profitability is for real.
Okay, so what's the trade idea? We're calling it the execution re-rate. The position is simple. Long DCTH, and the logic is that the market has already priced in the bad news about the slower rollout. That profitability and that amazing balance sheet provide a really nice margin of safety. Now, the catalyst is key. We need them to hit or even beat the high end of their guidance, getting to 28 cents by year end. If they can pull that off, it signals these execution issues are under control, and the market's focus is going to snap right back to that incredible growth engine they've built. And that is the setup for a major re-rating of the stock.
And of course, one last thing, you know the drill. This is not financial advice. All of the opinions we've expressed here today are just for informational purposes.